Hey, thank you so much for taking a few minutes to watch this video. My name is Ernie Brown. I'm one of the financial coaches and strategists at Wealth Without Wall Street. I want to share with you a strategy that I have found and learned and been implementing since 2016 personally, and now have the ability to every day be helping people implement into their financial worlds. And if you're watching this video, it's probably because you've been looking to optimize all of your dollars, right? Both for your control and use today, but also to set yourself up for success in the future. And I want to share with you a strategy, right, that I'm using, but ultimately has better results, ultimately, bottom line, than what tools are commonly promoted in the marketplace today, which for most people is a combination of savings accounts and retirement plans. And I don't want to talk about those things because they are average at best. I want to give you a taste of a process that we help people to use that ultimately creates a better foundation for your finances, right? The thing that we seem to be lacking, whether we've realized this or suspected it, is that we just don't have a great resource tool or process to follow with our dollars today that we can use that also gives us the ability to secure our future. And so I want to explain ultimately what this is just quickly to you. But really what this is about is a process called infinite banking, or it's also called becoming your own banker. And so really the idea is, let's take the money that we're using today and let's begin to control it in a way where we get to move into the owner's box. And what I mean by that is, and we'll look at this in just a second, but when you finance things, when you take loans, the person who benefits from the interest on those loans is the owner of the corporation giving the loan, right? And so ultimately, we want to find a way where we can move into that owner's box. And the way that we want to do that is just share, in our experience, when we work with people, I know there's multiple ways to buy cars, but the two main ways that we find, and I wonder if you're doing one or have done both of these, is to, number one, pay cash. And here's what that looks like. When we pay cash, here's what happens. We take dollars and we save them up, right? And then when we've saved and the vehicle's worn out, we go buy another, we take the cash out and we buy this. And so I did a little bit of math just to give you an idea. And for a family who's buying cars, maybe a $25,000 car, and buys this every 5 years, right? So saves money up, buys a car, saves more money up, maybe could earn 2% in a savings account over that time period, buys the car, begins saving up again. What I went and looked at is the interest that you would not be able to earn over that 25-year period. 5 cars, 25 years, $25,000 a car. And here's what that turned out to be. About $9,700 in missed growth, right? If you're able to keep the money in the account growing continuously, it would grow to X amount. But if you take that money out to buy cars and then replenish, you would lose about $10,000 of growth. The second way people buy cars is to take a loan. And here's what that looks like. You go to a bank, you don't save the money up, you go to a bank, you take a loan, and then you make payments. And the thing that people are always quick to point out is, who are proponents of paying cash, is, oh, I don't want to take a loan. I'm going to have to pay interest on that loan, which is true. And in the same scenario, $25,000 cars, we buy them every 5 years for 25 years. If the loan rate was 5%, a fair loan rate for a car, what that would look like ultimately is this much interest per car per year, or $16,000 over the 25 years paid in interest. And so the thing that I would point out is, yes, it is cheaper to pay cash than it is to take loans. But at the same time, it's pretty expensive. Both of those are big numbers relative to the amount of money spent on the cars, which is about the same amount, $25,000, right? You give up growth or you pay interest. And so ultimately what we want to do is move you into the owner's box. But here's the thing. When we talk about this, people will start to get a little bit, something just doesn't feel right about this. And so first off, what I'd say to you is, This is not a brand new strategy. This is not a get rich quick strategy. And this is also not magic. Ultimately, what we're talking about is building in a process to the things that you're doing now, just creating a better foundation. And that foundation is to use a very specific, a very specially designed whole life insurance contract. And before you say, oh, whole life that's a gimmick, Dave Ramsey told me to never use this tool, I just want to show you a very common example of a major corporation who uses this same tool. I went and got this very recently. We're in September of 2022, and I went and got this up-to-date report on Bank of America, right? Bank of America is a very major corporation in our country, right? And what I went and looked at is at their balance sheet. I went and looked at their life insurance assets. How much life insurance does Bank of America own? And so first of all, is it surprising to you that Bank of America would purchase life insurance? And if I told you that these dollars being in the thousands, we add these two amounts together, Bank of America owns about $24 billion in life insurance. And that's not death benefit. That's the amount of cash that they're putting into life insurance on their key people. If they're doing it, if they know something about it, should we be doing this? Which is available to us. It's commonly available. I told you I'm doing this. I help our people inside Wealth Without Wall Street do this. This is a tool that exists for everyone. We just don't see it as a foundation of what we use. And there's lots of reasons for that. But if Bank of America does it, shouldn't we pay attention to this? And so just in terms of the process, I just want to give you, well, here's how. Here's how this can work. Ultimately, in a family, there's a certain amount of cash flow, right? There's a savings rate that we're doing. So ultimately, the idea is to look at savings, create a better foundation for this, implement the whole life insurance policy, and then go take loans against it, right? So if we do savings here and we take loans here, we can talk more about that. I can give you more ideas about exactly how that works. We can go finance things, right? And the example that I gave is we can certainly do that with cars. If we do it with cars, can we do it with anything else? The answer is of course. And ultimately what we do is we take these savings, we implement the process of infinite banking, which involves loans, and we go finance the things that we're going to do anyways. That's a simple process. We're doing this with this step and this step. We just need to add this foundational tool and movement of money into the middle. And so just for practical example, right? It's like, this is all theory, but here's something that we did for Alex, somebody that we've helped. Alex had a very, very typical situation. He was about 40 years old, had a family. He had term life insurance in place, which is common. And he was spending about $200 a month for that coverage. He also had been a good saver and had built about $40,000 of a cash reserve, like an emergency fund, like you're supposed to do. And he was also, just like everyone else, buying cars. And we showed him, hey, we can create a strategy for you to start controlling this function. He had actually been taking loans for cars up until this point from banks. And we built a plan together to help him first, instead of renting this insurance, buy the permanent insurance, the whole life insurance, and redirect that cash savings of $200 a month into this coverage. And then we needed to find a way for him to build up cash to go buy the first car. And so we helped him, not immediately, but safely over time, transition this cash reserve into the insurance policy. And so we ultimately did that over a period of 8 years. And so we took $5,000 a year and made some payments over those years. And so that's what he did. When he paid off the car and it was time for a new one, he went and took a loan against the insurance policy, from the insurance policy, and he took the loan payment that he had been making, right? He had been accustomed to making loan repayments. Instead of making that to another bank, he made the payment, which was between $450 and $500 a month. He made that payment back to his insurance policy. So he started bringing the cash back, and he had the ability for the insurance policy to be growing. He had the loan at work and the loan repayment coming back, replenishing this account. Ultimately, here's what this is doing for Alex, is it's giving him control and ownership over this process, which who doesn't want to be an owner, right? But it's also building for him a future increase of cash. And we projected for him when he turns 65 years old, that he's going to be able to turn on an income stream of about $10,000 a year. And from age 65 until he passes away, to be able to safely take money out of this infinite banking concept, this insurance policy, and do this tax-free income. And so here's a question. Alex set up a system to create future benefits for him, right? $10,000 a year, not changing anything about his spending, just adding a different process into the fold. How many benefits are you getting right now from the things that you're doing? How many future benefits are you getting? And so just a very practical, what is this? What's the framework for making this happen? Here's an example of how we've built this for someone in the past. Now, for you, if you're listening to this and you make over $75,000 a year and you haven't set this up and you want to see how we can put this together in your world like we did for Alex, I want you to go below and set up a phone call and let's talk about exactly how we can do that. I look forward to talking with you. Have a great day.